Welcome back to the Legacy Radio Network. This is the Everything Financial Radio Show. I'm your host, Dennis Tubbergen, and we are chatting today with Mr. Ian Gordon of the Long Wave Group. And Ian, before the break, you were talking about the fact that it was your view that we start to see banks fail when we start seeing sovereign defaults. Now, in your newsletter, you state that another potential outcome, if you will, of this debt crisis would be new currencies potentially being introduced or a rollback of existing currencies. So can you explain what you might be forecasting or what we might see?
Well, I think, the new currencies that we're probably going to see are, in Europe, we're going to see the sovereign currencies adopted again. So we're going to see the lira adopted in Italy, drachma in Greece, and so on. So, as the euro starts to fall apart, because I'm absolutely convinced that the euro can't survive, because it's very difficult for a currency to survive when you don't have a political union, and when each nation within that currency group can make its own budgets and its own decisions regarding its spending and so on. So I just don't think the currency can survive, given the separation between a monetary union and a political union. So those currencies will sort of come back into being, I think. But my ultimate thought here is that the whole problem for all currencies is that they're based on fiat, they're paper. And paper money is debt money. So as long as you have paper money, you're always going to, and as long as you continue to increase the amount of paper that you issue, you're always going to increase the debt. And there's no time that a paper money system has survived in history, simply because governments get out of control with the printing of it. So I'm convinced that ultimately we will go back to currencies based on gold. And as I said in that piece that I wrote, that I felt that China would back the renminbi with gold, and so effectively forcing the rest of the world's nations to go on a gold standard system. But simply because if you want to trade, you've got to have currencies that people trust and be paid in currencies that people trust. So that I think the ultimate outcome of all of this is a return to some sort of gold standard system.
Ian, if you're a listener out there listening to some of the predictions that you're making, and incidentally, we've had a lot of guests that are looking at this debt situation exactly the same way that you are. One has to wonder, if they're an investor and they have a nest egg, if we see sovereign defaults, that's probably bad news for many bonds. It's probably bad news for stock markets. And the old asset allocation model says that you put money in stocks and you put money in bonds because the two asset classes are inversely correlated. They move in opposite directions. But listening to you, it sounds like we could have a bear market in both of those asset classes. Could you comment?
Well, I mean, we are having a bear market in some countries in both of those assets. I mean, the Spanish stock market is down about 50% since 2006, and the Spanish bond market is also losing significant amounts of money as interest rates rise in Spain, and the same can be said to be true in Greece and so on. And I'm of the belief that we are going to have simultaneous collapse of both of those asset classes, as we are having in the nations where their debt problems are overwhelming them, such as Spain, Greece, Portugal, and now Italy. And eventually the chickens are going to come home to roost within the United Kingdom and the United States, and interest rates will be forced up in those countries, and the stock market will be forced down, or will go down. Interest rates will be forced up because people will no longer want to buy the bonds of those nations, knowing that they are truly in a debt situation that cannot be repaid. And this really is, and I've talked about this before with you, this really is similar to the events of 1930. At that time, the whole monetary system of the world collapsed between 1931 and 33, and initially the weaker countries' debt was picked on, and then eventually it moved to the stronger currencies, and their debt was picked on. So even in the United States, and these countries were forced off at that time the gold exchange standard system. So even in the United States, which was by then the world's greatest creditor nation, had a very small federal budget deficit. Even there, investors started to pick on the United States, believing that that she wouldn't remain in the gold standard system. So they started to use their dollars to buy American gold. And that forced up interest rates in the United States during the Depression. So interest rates, to try to hold the dollar and keep the dollar's value, interest rates were forced up even in the United States during the Depression. So I think that today, the United States is the world's largest debtor nation. So eventually investors are going to turn on the dollar and say, that debt is unsustainable, can't be repaid, and therefore interest rates will be forced up.
Ian, as I listen to you talk, I'm reminded of a statistic that when one takes total sovereign debt and adds to it liabilities for entitlements, promises made to the populace, the United States is actually, as a multiple of its GDP, more indebted than Greece. So how do you explain the fact that the United States hasn't seen interest rate spikes, that the stock market still seems to be going up? Given the facts, it just seems that something different should be happening.
Well, the United States enjoys the dollar enjoys the status as the reserve currency, and so until that status is broken, dollars will flow to money will flow to the United States, and all oil around the world, and people will need dollars to pay for oil, to pay for copper, to pay for everything. Everything is denominated in dollars, and so until that system stops, and the Chinese have such a huge surplus that they basically have to fund U.S. debt, and so that they're supporting the U.S. debt position right now because they have such a massive amount of dollars in their central bank. I mean, simply because of the trade, that they do so much trade with the United States, and so many dollars go into China. China essentially uses those dollars to finance or to buy American debt. But that situation is changing because the Chinese economy is slowing dramatically. The world economies are slowing dramatically, so there are less dollars flowing to China now than there were, and that means there's less Chinese money going to be available to finance American debt. And the other thing I think is that China is in danger of imploding itself, and when that happens, she'll need to take all the money home to try to bail out her own banking problems.
Ian, when we're talking here about potentially the stock market declining significantly, bond markets taking hits because interest rates will spike, it brings me to the fourth point that you made in your most recent newsletter, and that is that not only are we already witnessing wealth reduction as this debt deflation unfolds, but it's your view that we're at the very beginning of that process, and there's going to be I believe you said massive wealth destruction to the tune of tens of trillions of dollars. That sounds ominous, and I'd like you to comment on that if you would, please.
Well, I'm a big believer that the stock market, stock prices have to ultimately reflect the reality of the economy. And we know that, the big bear market of 2932, the Dow Jones lost almost 90% of its value, dropping from 381 points to 41 points. We haven't seen anything like that at this stage, simply because the central banks have made so much money available to the banks, and these banks are investment banks, and, there's so much money going into the banking system. Not much is being lent out because there aren't any good borrowers to lend to anymore. So that money is being funneled into speculative things like stocks, derivatives, even commodities, and so on. So I think when the whole system starts to collapse, these markets will collapse with it, and we could get, and that essentially when the stock market collapses, that will take the sort of source of wealth out of the investors' pockets. They've already lost on their real estate holdings. Now they're going to lose on their stock market holdings.
So, Ian, in the couple of minutes we have left, someone listening to this that has a 401k plan or an IRA plan, what advice would you give them?
Well, we've always been of the position, and, I used to be a stockbroker, and, and because of my cycle, it was easy for me to see that around 2000, the stock market was going to go down, and that gold would go up, much as it did starting in 1929. And that's been the right course of action, so that for many of us, we've invested, many people who I've advised as a stockbroker and for myself, we've been heavily invested in the gold market, in the physical and in the gold stocks, and and that those gains have been fairly substantial in that arena, and they've been far better than they have been by being in the stock market. And the best way you can measure that is just measure the Dow Jones Industrials and divide it by the price for an ounce of gold, and you'll see that reached a peak in July 1999 of almost 44 to 1. In other words, it took 44 ounces of gold to buy the Dow Jones Industrials, and and today it's about 9. It takes only 9 ounces of gold to buy the Dow Jones Industrials. So, and that will come down to an extreme, as it always does. The extremes that we've had before are 1-to-1, where it takes 1 ounce to buy the Dow Jones, and we had that in 1980 when gold hit 850, as did the Dow Jones Industrials. So we will see. I'm pretty confident saying that we will see an extreme, and this time it might be even lower than 1-to-1.
Mr. Ian Gordon of the Long Wave Group, thank you for joining us today. And could you give the website one more time in case someone's just joining us?
Longwavegroup.com.
Thank you. We hope you'll come back.
Thank you very much.
We will return after these words. Stay with us.